And so it's the same, the same components, the Apples and Teslas, Microsoft, Amazon, those are the stocks that are leading the index to the upside. And for the most part, have left, nearly everything else behind. It's been really crazy. Good morning. Welcome back to Strong Valley Wealth and Pensions Monthly Market Matters. So today you got Chris and Jason, and we're going to spend just a few minutes going through where we are so far this year. We're recording this in early July, so I have a little June recap of the markets, talk a little bit about what's to come, and in a pretty brief video, you'll get a decent idea where we stand for the year. So. Jason, you want me to just jump right into
yeah, go for it.
Sort of market performance? Okay. So this is these numbers cut off basically at the end of June, which was last week. We sit right now with the Dow Jones Industrial Average year to date up about 5%. The Nasdaq's up about almost 40%, 39.5%. International markets are to the plus side about 11.5%, 1166. Bonds in a still rising interest rate environment are year to date up about 2 after about a negative 0.5% in June. And commodities are still pretty weak, so down almost 8% for the year at this point, even though June was a positive month. And then in terms of real estate, again, we're going to jump into this a little bit, but real estate investment trusts are plus about 4.5% for the year. I think you had, Jason, you punched in about 4.69%. So
yeah, I definitely want to dive into that. But I in reviewing some of the numbers that you mentioned, some takeaways that I've got from looking at this stuff, which I think is quite interesting. Of the Nasdaq is obviously the one that jumps out there, and of the main driving components of the Nasdaq, the big tech stocks in there. I think Apple is the only one that has actually made a new high. And so a lot of these components within the index, which are really driving this, are clawing back the unbelievable losses that they had last year. And so when investors look at this and maybe have some fear of missing out or things like that, and then they look at what these individual stocks or what these indexes did last year, and they look at the sheer roller coaster of what that has been like. That's a lot of what we've seen around the AI drivers and things like that have really pushed the tech. And you and I were also looking at some of the components of the S&P, which have been a driver I thought was really interesting.
So
it's driving that performance.
Yeah. So with the Standard & Poor's 500 up almost 17%, so it's roughly 500 stocks. If you took out the top 40, I think it's top 44, then it'd be negative for the year. The index would be, and sorry, that was for the month, but in the month of May, that number was 8. So the top 8, the positive performance or attribution from the top 8 stocks out of 400 or 500 rather in May made all the difference in whether it was a winning month or a losing month. And so it's the same components, the Apples and Teslas, Microsoft, Amazon, those are the stocks that are leading the index to the upside. And for the most part have left, nearly everything else behind. It's been really crazy.
Well, and that's where, when you look at the average investor out there, when you look at kind of what we call the apple pie blue chip style of names, when you look at, like, let's say the Vanguard Value Index, this is going to be comprised of names like Exxon, Johnson & Johnson, JP Morgan, Coke, Pepsi, Walmart, Costco, things like that.
Mm-hmm.
That index is up about 2.5% for the year. Right. And so, that's the bulk of what, at least, I know a lot of the people that I work with and a lot of retirees, they're not itching to have their entire retirement ride or die on 8 tech stocks. And so it's flashy, it's exciting to watch, but the real, when you kind of look in the breadth of the market and really look at the drivers behind this, the market itself on a whole is relatively flat for the year, which I think that's still better than a lot of people expected. When we look at what the fears that were around 6 months ago around when this inevitable recession is going to come, what's
Mhm.
happening with the banks, Ukraine, China, inflation, debt ceilings. There's been a lot of irons in the fire this year. So for the breadth of the whole of the market to be relatively flat, I think it still surprises people.
Yeah, no question. So to that point, sectors. So the three leading sectors, best performing sectors, halfway through the year here: information technology, dominated by Apple and Microsoft. They make up information out of the information technology sector. Apple, Microsoft make up 45% of that, followed by smaller contributions from NVIDIA, Broadcom, Cisco. Communication services, which are again dominated 50% of that index, is Meta, Facebook, and Google. So those two companies, followed by Netflix and T-Mobile. But those Netflix, T-Mobile, Verizon, those are all 4 to 5% contributors. Almost 50% of it is just in Meta and Google. And then consumer discretionary, and as we were talking about earlier, Amazon and Tesla are 42% of that particular index. So if you put Apple, Microsoft, Google, Meta, Amazon, and Tesla together, those 6 stocks are driving those three largest contributors to performance this year, which again, info technology, communication services, and consumer discretionary. So information technology is plus 42% this year, communication services plus 36, and consumer discretionary plus 32.
See, and
It's
I'd
just
love to, I don't have it in front
unbelievable.
of me, but I'd be curious to see how it did last year, because I think a lot of that,
Yep.
that it's bounce back performance. So there definitely have been some surprises. Another surprise that I think would catch most people off guard is in the real estate market. When we all saw the writing on the wall with what was happening with interest rates and mortgages starting to climb up last year, people that were getting mortgages in the fives, were disgusted by it after seeing mortgages at 2.75% and 3% for so long. But now a mortgage of 5% seems pretty good. And so with the mortgage rates climbing, so many people were betting on the real estate market to crash, or if they're waiting to get a home, I'm going to wait for this thing to rebound. But what we're looking at here on the driver of why real estate prices have not corrected, I've got a chart up right now looking at where the majority of the people in this country are sitting with their existing homeowners, where they sit with mortgages, and 90% of people in this country have a fixed mortgage below 6%, and over half the people have got a rate that's better than under 4. And so what's happening in this market is inventory. And so I've got another chart here showing it, home sales. And so what you're looking at here in the last decade, this has been the least amount of homes that have been for sale.
So what is this chart?
Decade.
This is
This is existing home sales, existing
okay.
homes available. Number of home sales. And so what's happening here is just showing that people aren't moving. You got to think about if you've got a mortgage at 3%, even if you want to move, or if there's things that you need in your home, you're more likely to remodel it than you are to move. Because if you move from a 3% mortgage to a 7% mortgage, it's a game changer in your budget. And so when you have such a low inventory in the market right now, there are still needs for homes. There are still people that are moving or creating a family or you name it, and they need homes, and there's just no inventory because people in their existing homes aren't selling.
That's true, and especially for magnet areas, you're still seeing prices increase, just because supply is so low. You still have normal churn, normal turnover, but I know there are a number of markets in Southern California, as an example, where home prices are actually increasing right now, even though mortgage rates are way up, which you'd think would work in the opposite. Oh, mortgage rates are way up, you're gonna have to adjust all the prices down. But because the supply is so short, you still have big demand for very few properties that are even available. So it's an interesting dynamic. I think one that we wouldn't have expected to be so, especially in residential real estate. I wouldn't have expected it to be so strong. But what about commercial? We're talking earlier about commercial real estate and large city commercial office buildings that are so vacancy rates are so high right now.
I think most major cities vacancies are above 20. You and I were looking at a stat earlier that in New York right now, what that means, in real numbers, they've got about 75 million square feet vacant, which is about 26 Empire State Buildings. The work from home movement has just been sticky. Once people ditch their commute and they're able to be, let's say as effective as at home, they don't want to go back to a building, and so these buildings are being incredibly difficult to occupy.
Yeah, pretty crazy. Pretty crazy. All right. We'll talk a little bit about interest rates, specifically sort of where treasuries and those type of rates are now versus before.
Yeah, when Kyle and Adam did a one of these podcasts, I think just a couple months ago, we've seen interest rates climb on basically every 3, 6, 9, 12. We've seen them all climb about another 0.5%, and that's because the economy has been a little bit stronger, I think, than expected. And the government's more inclined to raise interest rates 1 or 2 more times. And so that's already been reflecting into the yields. And so we've seen like a 1-year treasury or a 1-year CD go from about 5 to 5.5% now. And same with all the 3, 6, and 9 months. They've all jumped about 0.5%. So they're all north of 5 at this point. Because of the expectation. So if the government, which I think it's priced in about 90% probability that they're going to raise rates in July by 1/4 point, the market's probably not going to move much because it's already priced in. It's expected that they're going to do it. It would be more of a surprise now if they didn't. And so those rates are, the cake is already baked at that point.
Yeah, no, and that's like you mentioned. I think it's the 26th of July is the next opportunity for the Fed to raise, and the market's handicapping that, like you said, at 90% for another 1/4 point raise. Possibly, it'll be interesting to see what Powell has to say after the meeting. But again, what we're reading is probably going to have another raise either at the late September or early November meeting. And by then, again, what they're looking for is unemployment to tick up and GDP to be further constrained. And so if they get enough of that slow down and they get some deflationary pressure, like we're already getting through commodities that we talked about a little bit earlier, the thought is that they'll probably pause for some period of time until they get to the point where they're going to have to start easing interest rates again to get people to start borrowing and spending again. So it'll be an interesting thing, and there'll be even more pressure on the banks. And one of the things that we wanted to cover today too is sort of what we think might be still coming with respect to mid-sized to smaller banks, which are left with a lot of this large city downtown real estate portfolio. In other words, they're the lenders on some of these big buildings that are mostly empty. And we're seeing, certainly localized here, San Francisco, there were a couple of really big stories that came out in the last month about owners walking away from their mortgage payments on large buildings, whether they're hotel buildings or shopping malls or commercial buildings, and essentially handing the keys back to the lenders and saying, here's your building. We don't want anything to do with this anymore. So that's going to be something that we're going to definitely have to keep an eye on, and make sure that we're minding our P's and Q's when it comes to risk.
Right. Yeah. Interesting. Another note on what happened over the last month. The biggest thing, at least a discussion that I had with clients, everyone was worried about the debt ceiling and if the U.S. was going to default on debt. But just like they've done over the last, 87 times in a row or something since 1960, they once again passed it. And now in hindsight, it's like, of course they're going to pass it. Look how fast these politicians love to spend money. So just in the last 4 weeks since the passing, since June 2nd is when it was passed, the debt in this country has already gone up almost $1 trillion in 4 weeks. It's disgusting. $865 billion in 4 weeks that we've already spent. And so the thought that we weren't going to pass this, I don't know why we keep getting so worked up, and the media doesn't help on, oh my gosh, what if we default on our debt? Now in hindsight, of course they were going to raise it. Look how many bills they already had to get paid. Yep. And so this is insane, just how fast the debt is rising. But I thought this was kind of a noteworthy piece. So that iron is now out of the fire, and we've got more things that I'm sure we'll be worried about whenever this recession inevitably may or may not come, and we'll just kind of take it one day at a time.
Yep. Hey, we promised to be brief, so we want to wrap up with what's next.
Yeah, so we've got we'll have another one of these shorter sessions, the monthly market matters, at the end of this month, and then you'll get all four of us back together. We're doing that in early August.
Yeah, probably mid-August, something right.
Mid-August,
as soon as everybody's back in the office from all the summer travel and making sure we're back to work, all of us. So.
And then we'll get everything and go a little bit more in depth once we got all of us back together here. So you'll be hearing from us again in about 4 weeks, and then again a little bit deeper dive in about 6 weeks. So,
yep, sounds great.
There you have it.
All right, man. All right, thanks for doing this. Appreciate it.
Talk to you later. See you guys. Thank you.